Welcome, dear students. We will see chapter 10, that is lessons from market history. In this chapter, we will see the returns from the stock or the investment. We will see what do you mean by holding period return or HPR. We will see the return statistics for past hundreds of years. We will find the average stock return and the risk-free rate of return. What do we mean by that? Some statistics we will see from 1920-30 to current date. More discussion we will make on average returns. Then we will see the US risk premium, equity risk premium, and the crisis year 2008. We will have a look at that. The first one is, as we said, it is on returns. Returns is classified into two categories. One is the dollar return, the other one is a percentage return. So what do we mean by return actually? We invest in the beginning, so money goes from our pocket, so it is minus. You can see time zero, initial investment, you buy a stock, so money goes out of your pocket, so therefore it is minus, initial investment is minus. After 1 year, for example, you are selling the stock, so you will get the selling price, that is the green portion of the arrow mark is the selling price. You know, when you sell, you will get back your money. That's why it is plus. That's why the arrow mark is going upward. In the very beginning, when you buy the investment, money is going out of your pocket, so it is negative. After 1 year, if you sell the stock, money comes back, so it is a positive. And whatever price you sold, that is the ending market value. In this 1 year, the stock will offer you some dividend that will be also added back. And when you added back both the things, ending market value and dividend, you deduct the initial investment, you will get your dollar returns, isn't it? For example, you buy a stock at $90. That is the initial investment minus 90. End of 1 year, you sell it for 99. And the stock has given you dividend of $1. That means you purchase at 90. End of the year, you sell at 99. Get dividend of 1. That means total you get 100. You get 100 and you invested 90. So the 100 minus 90, that is equal to $10, is the dollar return of the stock. The next one is percentage return. Percentage return is the ending value minus the beginning value divided by beginning value. Here in this case, our example, 90 you spent, 100 you got, so you got the $10 return in 1 year. So 10 divided by 90 will be your percentage return. Therefore, dollar return is nothing but the dividend plus capital gain or capital loss. In the previous example, dividend is $1, capital gain is $9 because you buy at 90, sell at 99. Then $9 is the capital gain. Dividend income will be $1. Total will be dollar return $10. Sometime you buy at 90, you sell at 80, for example. Then there will be capital loss. So if the ending value is greater than the beginning value, you have a capital gain. If the ending value is less than beginning value, you have a capital loss. Now percentage return. The dollar return divided by beginning market value. In the previous example, you purchase at 90, you sell at 99, dividend 1, so total is 100. So the dollar return is 100 minus 90 is equal to 10, and the percentage return is equal to dollar return divided by beginning value. Dollar return is 10, beginning value is 90. That is the percentage return. Now the same can be distributed into two portions. Dividend plus change in market value over the period. As we have taken the example, $90 is the purchase price, $99 is the selling price. So the change in market value is $9. Dividend is $1. So you can say $1 plus $9 divided by $90 beginning value. The $1 divided by $90 is the dividend yield. $9 divided by $90 will be the capital gain yield. So dividend divided by beginning value is equal to dividend yield. Change in market value divided by beginning market value is equal to capital gain yield. I hope it is clear to all of you. Let us take another example here. Suppose you bought 100 shares of XYZ company 1 year ago. Today the price is 45. Over the last year you received $27 as the dividend. That is 27 cents per share. 100 share means $27 total. So you bought 100 shares of XYZ company 1 year ago, the same day today, 1 year ago at $45. So beginning price is 45 per share. During the year, you got a dividend of $27 from these 100 shares. End of the year, you sell the stock at $48 per share. That means you purchase 100 shares at 45, that is your beginning value investment is 4500. Ending value you sell at 48. So 4800 is the selling price of the shares. $27 is the dividend. So 4800 plus 27, so 4827 is the ending value. 4500 is the beginning value. Alright. So total return is equal to 327 from this particular stock. Alright. Again I am saying 100 shares you purchased at 100 shares at the rate of 45 each share. So 4500 you invested in the beginning to buy the share. End of the year you sell at 48 at share. So 48 a share multiplied by 100 is equal to 4800 is the selling price. So capital gain is equal to $300. Dividend is $27. So total gain is equal to $300 capital gain, $27 dividend gain is equal to 327. This is the dollar return. Alright. Now let us calculate the percentage return. 327 is the total gain divided by initial value is 4500. 7.3% is the percentage gain from this stock. Okay. Again 100 shares purchased at 45 is equal to 4500. Sold after 1 year at 48 a share. So 4800 is the selling price. So if selling price is more than buying price, capital gain. So here it is a capital gain. How much? 4800 minus 4500 is equal to $300 capital gain. The share can offer dividend to you. That is the dividend gain. It has offered $27 as the dividend. Therefore, the dividend gain is $27. 300 plus 27 is equal to 327 is the total gain. Now percentage return. Total gain divided by initial investment. 327 divided by 4500, 7.3%. This can be further divided into, you can say 300 divided by 4500 as the capital gain. 300 divided by 4500 is equal to capital gain. 6.67% is the capital gain. Remember, 300 divided by 4500 is equal to capital gain. 6.67%. 27 divided by 4500 is equal to 0.6%. So 6.67 plus 0.06 is equal to 6.67 plus 0.6 is equal to 7.27% or 7.3%. You can see here. So this is the way you can distribute the total gain into capital gain yield and dividend yield. You can see here capital gain yield and dividend yield. Dividend divided by initial investment will give you dividend yield. In the example, 27 divided by 4,500. 27 divided by 4,500 is equal to 0.06%. Similarly, capital gain is equal to 300 divided by 4,500 is equal to 6.67%. 6.67 plus 0.6 is equal to 7.3% or 7.27%. Alright, so this is the way we make the calculation. Initial investment is negative, that's why 4,500 shown as negative. End of the period, you got 300 as the capital gain because you sell at 4,800, and the dollar gain is 27, that is the dividend yield 27. So 27 divided by 4,500 will be the dividend yield. 300 divided by 4,500 is equal to capital gain yield. And total 327 divided by 4,500 is equal to total yield. Now, next section of the discussion is holding period return. Holding period return is the percentage return, with total percentage return you got over a period of time. Say for example, here you have n number of years you invested. So every year you get some return. 1 plus R1 multiplied by 1 plus R2. For example, 3 years. Then 1 plus R3. If 4 years, then multiplied by 1 plus R4 minus 1. How many years? You just go on 1 plus R multiplied by the same number of return of the year. You just go on multiplying minus 1 will give you the holding period return. Say for example, your holding period is 4 years. You hold a stock for 4 years. And the stock has given you 10% return in the first year, 5% return in the second year, 20% return in the third year, 15% return in the fourth year. Therefore, the returns will be 1 plus 10% is equal to 1.10 multiplied by 1 plus minus 5% is equal to 0.95 multiplied by 1 plus 20% is equal to 1.20 multiplied by 1 plus 15% is equal to 1.15 whole multiplied by minus 1 will give you 44.21% is the holding period return. So, a famous set of studies dealing with rates of returns on common stock, bonds, treasury bills was conducted by Roger Ifston and Rex Greenfield. They have gone through a period of 1926 to 2015 for 5 different important types of financial instrument in the US. What are they? Large cap stocks, small cap stocks, long-term corporate bonds, long-term US government bonds, and of course treasury bills. These are the 5 instruments Roger Ifston and Rex Greenfield they have taken for the study, and they made the study from 1926 to 2015, and they found interesting finding here. If someone has invested $1 in treasury in 1925, after 90 years in 2015, that $1 will give $20 or $20.78 in 90 years if it is treasury. Little more risk, and it is no risk, treasury is the government backed security, and the most secured one, we take it as a risk-free return. So it gives a very safe return and lowest return. If you take little more risk, you can buy a long-term US government bond. You invest $1, and after 90 years, the return you will get from this government bond is how much? 142.8 35. That means $1 invested in 1925 will make you $142.35 in 2015. Little more risk you take. You buy a long-term corporate bond, okay, and a little more return you can get. Similarly, if you are taking a small cap stock, you get your $1 will become $36,931 in 90 years. See, definitely higher return, and for getting this higher return, you have to take high risk. If you are taking a large cap stock, it will make you 7,346 in 90 years. This is the way different type of securities are being taken into account and the returns are provided here. Therefore, we saw if risk is high, return is high. If risk is low, return is also low. If you are taking the safest return, the risk is also very low, like treasury bill. The $1 you invest, you get only $20. Out of that, inflation is $13. So only return is $7. But it is the risk-free return. But if you are taking a small cap stock, you are getting maybe 36,931 out of $1. But a lot of risk you have to take. Therefore, the risk and return came into the picture now. How to measure them? The return normally we take as the mean return, as the average return of the stock. There is a small mistake here. Make it correct, please. Mean return is equal to R bar, not plus. R bar is equal to, R bar is nothing but the mean return or average return. That is equal to R1 plus R2 plus R3 plus R4 plus RT, like that, divided by T number of years. So R bar is equal to, R bar is the average return, is equal to the return of different years you add divided by number of years. Now, if you are measuring the return, you have to measure the risk also. There are many different ways of measuring risk. The standard deviation is one of them, which is very popularly used for measuring the risk. So standard deviation is equal to square root of the variance, that is nothing but the return 1 minus average return to the power square plus return 2 minus average return to the power square plus return 3 minus average return to the power square, like that up to return t minus average return to the power square, divided by t minus 1. For the sample standard deviation, you make t minus 1. For the population, you make t. So normally we do for a sample, so we do it t minus 1. And t is the frequency distribution of the returns. Here is the historical return from 1926 to 2017. Around 90 plus years history is provided here. Small cap stocks gives you 16.5% return, the highest return. But don't be excited. At the same time, the standard deviation is 31.7%, too high. Large cap stock 12.1, standard deviation is 19.8. Long-term corporate bond gives 6.4 with a SD of 8.3. Long-term government bonds gives you 6% with a standard deviation of 9.9. Inflation is 3% and its standard deviation is 4. This is the way we calculate the return and risk. So, if we profile in a graph, how we will get the graph? High risk, high return, low risk, low return. The risk premium is the added return over and above the risk-free rate of return. Normally, the US Treasury bill is taken as the risk-free rate of return. So here in this 90 plus years history, we can take 3.4% as the risk-free rate of return. That is the US Treasury bill return. Over and above 3.4, whatever the return comes, that becomes the risk premium for taking that particular risk. Say for example, if you want to take the risk premium of large cap stocks. See here, large cap stocks gives you how much return? 12.1%. Large cap stock, the second one, 12.1%. Risk-free rate of return is how much? 3.4%. So what is the risk premium? 12.1 risk premium is the rate you are taking, the additional risk you are taking. Without any risk, you can take a US Treasury bill. You can comfortably get 3.4%, isn't it? If you are taking a risk and buying a large cap stock, you are getting how much? 12.1%. Without risk, what is the risk-free return? 3.4%. So 12.1 minus 3.4 is equal to 8.7% is the risk premium you are getting for taking the additional risk of taking a large cap stock. So 8.7% is the risk premium for large cap stock. Similarly, what will be the risk premium for some small cap stock? The small cap stock gives you 16.5% minus risk-free return is 3.4%. 13.1% will be the additional risk premium you are getting for buying a risky asset. Similarly, what is the risk premium from long-term government bonds? It is 6% minus 3.4% is equal to 2.6% is the risk premium for buying a long-term government bonds. This is the way we calculate the risk premium. So 8.7% we have calculated is the risk premium of the large cap stocks in the US security market. How we got it? Large cap return minus risk-free return is equal to risk premium of large cap stock. The average excess return from small cap stocks, as we have discussed, also small cap stock, 13.1%. So any return you can now calculate the risk premium, the return the stock offered or the investment offered minus risk-free return is equal to risk premium. Hope it is clear. The average excess return from long-term corporate bond is 3%. 6.4 minus 3.4 is equal to 3%. Suppose that the Wall Street Journal announced that the current rate of 1-year treasury bill is 2%. So you see, now you have calculated for 90 plus years all the risk premiums you have calculated. Now Wall Street said, today the Wall Street announced that current 1-year treasury return is 2%. What is the expected return of market of small cap stocks? You know, we calculated the small cap premium in the previous slide. So add that with 2%, that is 13.1 was the premium of small cap stock. Risk premium for small cap stock we calculated in the previous slide, 13.1%. 13.1% will be added with risk-free rate announced today by the or yesterday by the Wall Street Journal 2%. You add back. Then you will get the return for the small cap stocks. Right now, given the risk-free rate of 2%, we have an expected return from the small cap stocks of US right now is 15.1. 13.1 is the 90 plus years risk premium we calculated. That risk premium you will add back to the current risk-free rate. You will get the the expected rate from the small cap stocks. Like that, for any investment, you can calculate the expected rate of return. You can put the risk and return in a graph and you can find risk return trade-off. You can see once the standard the return of T-bills is lowest, the risk is also lowest. Next is bonds. The return is lowest and the risk also lowest. Large cap stocks, return is little higher, risk also higher comparatively. Small cap stocks, return is the highest, risk is also highest. So high risk, high return, low risk, low return. So risk statistics 10.5 we will discuss in the next section.